Why do oil prices rise during conflict? Oil prices rise during conflict not only because of actual supply loss, but because modern energy markets operate on expectation, probability, and risk pricing. Crude oil is traded globally through futures contracts. These contracts reflect what traders believe oil will be worth weeks or months ahead. So when geopolitical tension increases, markets begin calculating the probability of disruption. Even before a single barrel is lost, prices react. There are 4 structural reasons behind this pattern. First, production risk. Conflict can damage oil fields, pipelines, export terminals, or refining infrastructure. Energy facilities are high-value assets, and even limited damage can reduce output significantly. Second, transportation vulnerability. Oil does not move directly from producer to consumer by land in most cases. Nearly 2/3 of internationally traded crude travels by sea. That means maritime chokepoints become critical. Third, insurance and freight costs. When shipping routes enter a high-risk zone, war risk insurance premiums surge. Tanker operators demand higher freight rates. Even without physical disruption, transportation becomes more expensive, and that cost is reflected in oil pricing. Fourth, strategic reserves and speculative behavior. During uncertain periods, countries and corporations often increase stockpiling to secure future supply. At the same time, financial traders may increase long positions in crude as a hedge against instability. Both actions tighten market liquidity. Now consider a real-world example of structural vulnerability. Roughly 1/5 of global oil trade passes through a narrow maritime corridor known as the Strait of Hormuz. This passage connects the Persian Gulf to the open ocean. It is geographically narrow, about 33 kilometers at its tightest point, yet it carries approximately 20 million barrels of crude oil per day, along with significant volumes of liquefied natural gas. Multiple energy-exporting nations depend on this route to access global markets in Asia, Europe, and beyond. Because there are limited alternative routes with equivalent capacity, any tension affecting this corridor introduces systemic risk into global supply chains. Historically, periods of heightened military presence, sanctions, tanker seizures, or regional escalation near major choke points have coincided with rapid oil price spikes, even when physical supply remained intact. This demonstrates an important principle. Energy markets respond to uncertainty more quickly than to confirmed shortages. Oil is not priced only on barrels produced. It is priced on the perceived security of the entire supply network, production, transport, storage, and trade finance. That is why oil prices often rise within hours of conflict headlines. The market is not reacting to war itself. It is reacting to the increased probability that supply flows could be interrupted. In global energy economics, risk becomes cost, long before scarcity becomes reality.